Welcome back. Today we're looking at a very detailed report on NASDAQ, ASST, which frames it as a high-risk, high-reward baby MicroStrategy, currently trading around $1.05.
Right, and the core idea that this is a hidden gem under $2, it's strong. But, the way the analysis is structured is actually working against it.
I think so too.
While the report is packed with essential quantitative data, reorganizing its dense structure is absolutely critical for maximizing engagement and clarity.
Yeah, I agree. You hit the reader with the whole balance sheet right out of the gate. The weakness is presenting all those complex details, the $760 million capital raise, the asset floor, the volatility, that big Q3 loss, all in one paragraph.
It's just too much. It's cognitive overload.
It is. And it dilutes the impact of both the bullish and the bearish points you're trying to make.
Exactly. So the suggestion for improvement is pretty straightforward. Segment the material into clear, titled sections. You need to create a logical separation between the core valuation and the risk analysis.
So basically just introduce clearer headings. For example, you could start with something like ATST's tangible asset floor, focusing on the hard assets, the Bitcoin, the cash. Then maybe follow up with the strategic potential, leveraging Ramaswamy's influence before you even get into the technical pressure points and risk assessment.
And speaking of that strategic potential, I think that's a fascinating angle. The report establishes the connection to Vivek Ramaswamy and the Strive merger, but it doesn't fully exploit that context against the technicals.
It feels like a huge missed opportunity, doesn't it? The weakness here is that the strategic advantage, that shareholder-first influence, the capacity to generate another, $736 million with warrants?
A massive number.
It's just listed like a data point. It's not being leveraged as a powerful counter-narrative to the short-term bearish outlook.
Right, we need to make that connection explicit. The suggestion is to directly connect that massive, untapped capital-raising capacity to the long-term thesis. You need to position it as the very mechanism that insulates the stock from these minor technical dips.
Exactly. So instead of just listing the warrant capacity, use it as a rhetorical tool. You could illustrate how that $736 million completely changes the valuation equation.
How would you phrase that?
Maybe ask the reader directly. Something like, is the short-term double bottom zone truly the primary focus here? Or is this massive warrant potential the real differentiator?
I like that. It reframes the whole argument. That shift in framing is crucial. Now, let's talk about the major financial red flag.
The big loss.
The big loss. To maintain confidence in the asset floor thesis, the report has to more decisively neutralize the concern around that significant $192 million Q3 net loss.
That number just jumps off the page. And the current explanation is, it's just too vague. The weakness is mentioning the loss as a major risk, but then only attributing it to mostly merger costs.
It leaves you hanging.
It leaves the reader with this lingering uncertainty about the nature of the loss and the company's actual operational health.
And since that loss is so critical for any investor looking at short-term risk, the suggestion is that the report needs to provide a sharp, actionable clarification. It must distinguish non-recurring transactional costs from core operating expenses.
Absolutely. Bolster the explanation. Confirm for the reader, is this loss primarily non-cash, like goodwill impairment, or is it a specific, one-time transaction cost that absolutely will not recur?
That's the key.
That kind of decisive clarification assures the reader that it doesn't actually threaten the existing cash position or their whole asset accumulation strategy.
Okay, so to just quickly sum up this critique, first, restructure the dense material for better reader impact and clarity.
Second, you have to integrate that strategic $736 million capital raise directly into your long-term thesis. Use it to counter the short-term volatility.
And finally, provide decisive, sharp clarity on the non-recurring nature of that $192 million Q3 loss. If you make those revisions, we would love to see the updated analysis.